Up next on our list here, we have VTI, which is the Vanguard Total Stock Market ETF. This ETF tracks the performance of the CRSP US Total Stock Market Index, and this index represents 100% of the US investable equities market, meaning that you own a little piece of every single publicly traded stock in the United States through this fund. Now, just like VOO, this is going to be a market value weighted index, and that means that a larger company is going to carry more weight. So you're still going to see most of your money concentrated into the top holdings, but this is going to own a lot more individual company stocks. For example, with VOO, you own about 500, and with this particular investment, this is going to give you exposure to over 3,500 different companies, so you have more exposure to medium and small sized stocks or companies through something like VTI. As far as the expense ratio goes, this comes in at the same figure as VOO at 0.03%, and the dividend yield over the last 30 days is 1.22%. You can also get more details here about the benchmark as well as the performance over different periods of time. So year to date, for example, the return here has been 20.32%. If we look here at the portfolio composition, we can see that the number of stocks held within the fund is 3,656, which is quite a bit more than the 500 that you will see in VOO. However, there is quite a bit of overlap here between these funds because they are both market value weighted. In terms of the total assets held, this fund has an astounding 1.7 trillion in total invested capital. As far as the style box goes, this is in the same category here of VOO, being a blend of value and growth and heavy concentration into large-sized companies. So this will have a similar amount of risk to VOO, but it is slightly more aggressive because of the fact that you're getting exposure to the entire US stock market and picking up more of those medium and small-sized companies as a result. And smaller companies are going to be inherently more risky than larger, more well-established companies. Just like before, we can take a look at the sectors in terms of the overall exposure. This is going to be very similar to what we saw with VOO, and we can also look here at the top holdings. So for example, in this case, 6.14% of your money goes into Apple stock, whereas for example with VOO, we know that was closer to about 7%. So even though it is still pretty top heavy here in the big names and big tech here, looking at Apple, Microsoft, Nvidia, etc., you have slightly less of your money going into all of these top holdings because of the fact that you're picking up those bottom 3,000 or so stocks that are just not being allocated into VOO,